Stock Daily Insights. Your daily market compass.
After yesterday's sell-off, the U.S. stock market attempted a rebound today, while Israel announced plans to retaliate against Iran. Escalating tensions in the Middle East continue to weigh on market sentiment. The S&P 500 opened slightly lower, but thanks to the strength in chip stocks, the market found some support, and the index turned positive before midday. Fresh ADP employment data also helped ease investor concerns over a deteriorating labor market. The U.S. added 143,000 jobs in September, beating the forecast of 120,000. After 5 consecutive months of slowing growth, this surprise rebound suggests the labor market may be stabilizing. This contrasts with other indicators showing signs of cooling in the labor market, indicating that the U.S. economy may be more resilient than previously thought. As a result, investors are becoming more optimistic about the prospects of a soft landing, focusing more on the U.S. macroeconomic outlook than reacting impulsively to Middle East tensions. For the remainder of the trading session, the major indices traded sideways, closing mostly flat, indicating a lack of conviction from both bulls and bears. The VIX volatility index edged lower but remained near 19, signaling that market anxiety persists. With the markets awaiting Israel's response to Iran's missile strikes overnight, tensions remain high. The U.S. has warned that Iran's actions will lead to severe consequences, while Israel has vowed retaliation. The potential for further escalation in the Middle East continues to loom, with Iran closing major airports and airspace in preparation for Israeli attacks. Despite this, Wall Street expects the conflict to remain contained and not escalate into a full-scale war, which has helped U.S. stocks demonstrate some resilience amid the ongoing uncertainty. The markets are still functioning in an orderly manner, without any panic-driven selling. However, from a seasonal perspective, the VIX is only halfway through its typical upward trajectory. If historical trends hold, we could see further increases in volatility over the coming weeks, which would put additional pressure on the stock market. Currently, the S&P 500 is still trading below both its 5-day and 10-day moving averages, and the Nasdaq 100 shows a similar pattern. Investors are weighing the impact of the ADP jobs report against Middle East tensions, making it difficult to determine the market's direction. As we enter October, increased uncertainty has led to a cooling of risk appetite. The market is now in a waiting mode, seeking new data and signals to determine its next move. Tomorrow, we'll get the initial jobless claims report, and Friday brings the all-important non-farm payrolls, NFP, report. According to Bloomberg estimates, the September NFP is expected to show a modest gain of 130,000 jobs, with the unemployment rate holding steady at 4.2%. If the labor market appears weak, traders are likely to increase their bets on a substantial interest rate cut in November. In my view, regardless of the outcome of this jobs report, there will still be ongoing debate over the size of the November rate cut. Goldman Sachs liquidity expert Scott Rubner, in his latest report to clients, expects short-term volatility and holds a pessimistic outlook for the next few weeks. However, he predicts these negative factors will dissipate by the end of the month, with the S&P 500 likely to stage a strong rally, starting on October the 28th, potentially reaching 6,000 points by year-end. While his predictions have been accurate in the past, his outlook for August and September was quite the opposite of what actually transpired in the market. So, while it's useful to listen to the experts for guidance, always take their opinions with a grain of salt. In practice, it's important to follow the market's trend and be flexible. If the market moves contrary to your expectations, be quick to reassess and adjust your strategy. With demand for safe haven assets waning, U.S. Treasury yields have rebounded, leading to a drop in bond prices. In the long run, U.S. Treasury yields are primarily driven by Federal Reserve policy, the U.S. economic cycle, and the Treasury's issuance schedule. While sudden global events can impact bond prices, these effects tend to be temporary. Now, let's briefly touch on a few individual stocks and sectors. Chinese stocks continue their strong rally. Even with mainland China and Hong Kong markets closed for holidays, Chinese stocks listed in the U.S. have surged across the board, reflecting the intense buying activity from foreign investors. The positive momentum is undeniable. There's a palpable sense of urgency, with even unlikely participants, like monks, opening brokerage accounts and rushing to invest. Two forces are driving the surge in Hong Kong and U.S.-listed Chinese stocks: aggressive buying by bulls and short covering by bears. According to a report by S3 Partners, this rally in Chinese stocks has wiped out about $3.7 billion in gains that short sellers had made so far this year. leaving them with a net loss of $3.2 billion. The stocks causing the most pain for short sellers include Alibaba and JD.com. However, traders shorting NIO, Li Auto, Spang, and Pinduoduo are still in profit, as these stocks have yet to recover all their losses from earlier in the year. As of September the 30th, the short interest in the Hong Kong market has dropped significantly, with the short-selling ratio falling from 21.8% on September the 16th to 10.2%. That's a 50% reduction, meaning there's still plenty of fuel left for further gains. Given the strong fiscal and monetary stimulus from the Chinese government, which exceeded market expectations, I believe this bullish trend in Chinese stocks could last for several months, potentially until the end of the year. However, because the recent rally has been rapid and intense, there's a risk of a pullback after the holiday period. To protect your profits, it's essential to set trailing stop-loss orders. My view on Chinese stocks remains the same. They're great for short-term speculation to take advantage of central bank liquidity, but not for long-term value investing. Many Chinese companies listed in the US are actually offshore holding companies with limited transparency and little connection to the domestic operations in China. Therefore, be sure to manage your positions carefully. Agora had an outstanding day, with its stock surging nearly 80%, and at one point, it was up more than 125%. OpenAI released its real-time API open beta today, with voice partners including Agora and Twilio. Agora's brother company, Agora, for the US and international markets, was spun off in May 2023. Agora focuses on the Chinese market with headquarters in Shanghai, while the US-based Agora is headquartered in California. Tesla reported third-quarter vehicle deliveries today, which fell short of expectations. The underperformance was attributed to incentive measures and low-cost financing failing to boost demand for its older models in an increasingly competitive market. For the quarter ending September the 30th, Tesla delivered 462,890 vehicles, a 6.4% year-over-year increase, and a 4.3% sequential increase. While this marked the first quarterly growth for Tesla in 2023, reversing the decline from the first two quarters, it still missed analysts' consensus estimate of 469,828 vehicles, leaving investors disappointed. As a result, Tesla's stock dropped more than 6% in early trading. The competition in the electric vehicle (EV) market is heating up. We all know how fierce it is in China, but in the US, General Motors, GM, reported a record 32,195 EV deliveries in the third quarter, up 60% year-over-year and 46% quarter-over-quarter. GM's market share in the US EV market rose from 7.1% in Q2 to 9.5%. This shows that it's not that EVs aren't selling, but rather that Tesla is facing tougher competition and losing market share. For the first 3 quarters of this year, Tesla's sales have fallen by 2.3% year-over-year. To match last year's delivery total of 1.81 million vehicles, Tesla would need to deliver a record-breaking 516,344 cars in Q4. Failing to hit this target could result in Tesla's first annual decline in deliveries. Moreover, Tesla's Q3 sales increase was largely driven by price cuts and promotions, putting pressure on its profit margins. But really, the shorts can say whatever they want. It doesn't faze Elon Musk. He said before that Tesla isn't just a car company, it's an AI company. You can't judge Tesla's growth purely by the number of cars it sells. The real test will be what kind of products or advancements in autonomous driving Tesla unveils on October the 10th, which could be the next major catalyst for the stock. Today, shares of health insurance giant Humana plunged by nearly 11.8%, and at one point during the session, they were down more than 23%, making it the worst performing stock in the S&P 500 today. The sharp decline came after the company disclosed in a regulatory filing that only about 1.6 million members, or 25% of its Medicare Advantage plans, will qualify for a 4-star rating, or higher in 2025. This is a significant drop from the 94% of plans that will receive this rating in 2024. This shift is expected to impact the company's performance in fiscal 2026. Humana's stock has already dropped 45% this year, and has been cut in half since its peak in 2022. If you're not familiar with the US health insurance industry, this drop may seem surprising, but from a technical analysis standpoint, today's recovery in Humana's stock after the sharp sell-off is mainly due to the price hitting a major support level on the monthly chart. The rebound was driven by short covering and dip buyers stepping in. If you're someone who understands this company well and believes today's price offers a good entry point, and you already bought in, then $180 is a key support level to watch. You can use it as your stop loss. As long as the stock doesn't break below today's low, you can expect a continued rebound. However, if it quickly falls back below today's low, that's a sign the stock hasn't found its true bottom yet. On the flip side, Joby Aviation, a company developing electric air taxis, saw its stock soar nearly 28% today. This spike followed the announcement that Toyota has invested $500 million to help Joby kickstart its commercial operations. The funds will be used to cover certification and production costs for Joby's electric air taxis. This is part of a 7-year partnership between the two companies, with Toyota having now committed a total of $894 million to Joby. These small-cap stocks often don't have strong fundamentals, and their price movements are driven mostly by the mood of large investors and the skills of traders. With the broader US market becoming less attractive lately, capital is shifting towards Chinese stocks and small-cap companies. For example, aircraft maintenance service provider Soars had its IPO today, and the stock surged more than 36% on its first day of trading. With an initial offering price of $24, founded in 1911, Soars provides maintenance services for both commercial and military aircraft. With Boeing facing ongoing issues and new aircraft deliveries slowing down, airlines are being forced to keep older planes in service longer due to strong travel demand, and as these older planes require more maintenance, companies like Soars are seeing a boost in demand for their services. After a summer slowdown, corporate IPOs have picked up in recent weeks, fueled by the stock market rebound and renewed hope for a soft landing in the economy. Thank you for watching today's market update. For more insights and daily stock market analysis, don't forget to subscribe to our channel and turn on notifications. Share this video with others who might find it helpful, and leave your thoughts or questions in the comments below. See you in the next update.